You know, when I look at markets and at institutions together, well, I do not see this as just another headline you can scroll past. You see, this feels different, and let me tell you something, it is important you hear that right away. I will speak to you like an old friend who has watched a lot of cycles and made a few mistakes along the way so you can avoid the ones that still hurt. You understand temperament matters more than cleverness when the ground starts to shift under your feet. Now, listen, the point of this conversation is simple and practical. You will get a clear diagnosis of what is happening. You will learn why it matters to your money and your life, and then I will give you plain steps you can take tonight and this week to protect yourself and to position for opportunity when the dust settles. And I will tell you this, I am not trying to scare you. I am trying to wake you up to the kind of structural risk that does not always show up as a headline. It shows up first as patterns, and then, if ignored, it works its way into prices and livelihoods. So what do I mean by structural risk? You see, it is not just a day when stocks fall. A market fall is a symptom. Structural risk is when the rules of the game become uncertain or when the institutions that enforce those rules begin to wobble. When that happens, markets do not behave like they did yesterday. Liquidity becomes scarce. Price discovery becomes messy. Confidence, which is the quiet glue of investment, starts to peel away. And when confidence peels away, well, that is when things get expensive for everyone. You know, I have seen panics before, and some of them were intense and some lasted longer than folks expected. But in each case, the ones who did best were not the boldest market timers. They were the most prepared. They kept cash or cash-like reserves. They stayed with quality businesses that earned real returns. They avoided leverage that claws at the throat when markets moved the wrong way. And they kept a temperament that allowed them to act rather than react under pressure. Let me be direct here and plain. You do not need to become an expert in every trailing news item. What you need is a framework to read signals and act with discipline. Today, I will walk you through that framework. I will explain which signals matter more than others and why coordination failures among governments, regulators, and corporate leaders can magnify market stress. I will show you how to translate those signals into sensible portfolio rules and into practical steps you can take if you are a retiree or a saver or a business owner or someone who runs a household budget. This is not theoretical. Right now, there are signs in politics, legal arenas, and business behavior that will change the backdrop for investment decisions. When leadership is under strain, the certainty of policy decisions fades. When policy certainty fades, so does the predictability of cash flows and valuation models. That creates a broader risk that cannot be hedged away with a single trade. You see, hedges cost money, and some risks are not hedgeable because they change the rules of how markets work. So here is how we will proceed in plain English and without drama. I will first diagnose the core signals that should make you pay attention. Then I will explain how those signals translate into market dynamics that create a crash scenario rather than a routine correction. Next, I will give you practical rules for positioning your portfolio and your balance sheet while the uncertainty is elevated. After that, I will walk you through tactical moves for several common investor types and then offer a checklist of indicators to watch as this story unfolds. Finally, I will close with a calm philosophy about what long-term success looks like in times like this. You see, the aim here is not to predict the exact day of a bottom or to sell you a recipe for getting rich quick. The aim is to help you preserve capital, avoid permanent impairment, and to be ready to deploy capital when real opportunities appear. Like I always say, temperament counts for more than intellect in investing. You understand that that is the heart of what we will cover. One more thing, and this is important, please do not confuse urgency with panic. I will be urgent because the stakes are real. I will be deliberate because panic makes people do foolish things, and that helps no one. If you keep your head and act on sensible, simple rules, you will be in a far better position than most when the cycle turns. All right, now take a breath and listen closely because the next part will lay out the diagnosis you need to understand before you take any action. I will do this calmly and plainly, and I will keep repeating the main points so they sink in. You see, repetition matters in moments like this because when markets shout, your memory shorts out and discipline slips. So stay with me and let us walk through this step by step together. You know, when people say the market is crashing, they often picture flashing red numbers and traders shouting on television screens. But let me tell you something, that's not how a real crisis begins. A real crisis starts quietly. It starts when confidence breaks in places you can't see on a chart. You see, it's when the foundation of trust that holds the system together, starts to crack just a little at a time. And when enough of those cracks appear, the walls give way fast. Now, let me help you understand where we really are right now. Because this moment, well, it's one of those periods that history will remember, not just for price drops, but for what those drops revealed about how fragile the structure had become. You see, over the past several months, we've had signals piling up like overdue warning notices. Corporate earnings reports have been shrinking, not because people stopped buying completely, but because costs rose faster than revenues. At the same time, governments are running deficits that would have been unthinkable a generation ago. You know, it's like trying to bail water from a leaking boat with a paper cup. The math just doesn't hold up forever. And here's the real signal that should make you sit up: liquidity is tightening everywhere. I don't mean only in the big banks. I mean in small businesses, in credit cards, in household budgets. When credit slows, the system starts grinding down. You see, liquidity is like oxygen. Nobody notices it when it's abundant, but when it's gone, everyone gasps at once. Now, some folks on television will tell you this is just a correction. They'll say markets always bounce back. And, well, that's true eventually. But the problem is, not everyone survives long enough to see that bounce. You see, markets can stay irrational longer than most investors can stay solvent. So the trick isn't to guess the rebound. The trick is to endure the decline. Let me tell you something from experience. Every crisis I've lived through had one common pattern. People ignored the early warnings because they didn't feel bad yet. You understand? In the late 90s, valuations screamed overconfidence, but optimism was intoxicating. In 2008, balance sheets were rotten, but folks said, well, this time the system is smarter. Every single time, people rationalized the risk until they couldn't. Now, if you zoom out, what we're seeing today isn't just market volatility, it's institutional fatigue. Governments, corporations, and central banks have been propping up confidence for too long. You see, when policymakers become market managers, sooner or later, the market stops believing in the policy. And once trust evaporates, no interest rate cut or press conference can patch it up. You understand, markets are mirrors. They reflect behavior. When leadership sends mixed signals, investors start to hedge not just their portfolios, but their faith in the system itself. That's what makes this moment dangerous. We're not just talking about price risk, we're talking about credibility risk. Let me put this in simple boardroom terms. Imagine a company where the CEO keeps assuring employees that everything's fine while quietly cutting budgets, freezing hires, and selling stock options. You see, eventually, the workers and investors stop listening. They sense something deeper is wrong. And once that belief sets in, no speech can reverse it. That's where we are. Only this time, the company is the global economy. Now, some of you may be thinking, but Warren, haven't we always bounced back? Yes, we have, but each recovery leaves new scar tissue. Debt piles higher. Safety nets get thinner. And the next rescue becomes harder. You see, resilience doesn't mean invincibility. It just means the system can bend until the bending becomes breaking. The Federal Reserve, has tools, interest rates, liquidity injections, asset purchases, but those tools lose power when trust and leadership erodes. You can print money, but you can't print confidence, and that's the real shortage. Now, confidence. So what are the signs that the crash is truly here? Well, let me give them to you in plain English. First, when good businesses start losing access to credit, not because they're failing, but because lenders themselves are afraid. Second, when you see sharp swings, not just in stocks, but in currencies, commodities, and bonds, that's the sign that institutional investors are scrambling for safety. Third, when government policy becomes reactive instead of proactive, when every speech starts with, "We are monitoring the situation," that's not reassurance. That's acknowledgement of a loss of control. And finally, when the average citizen starts saying, "I don't trust the system anymore," well, that's when you know confidence is cracked from the inside out. You see, markets are not moved by logic alone. They move by psychology, by fear and faith, by panic and hope. And right now, fear is starting to outweigh faith. That's why you feel this tremor in every sector: tech, banking, housing, energy. It's all connected because the underlying trust that ties them together is fraying. Now listen, I don't want you to mishear me. This isn't about doom. It's about diagnosis. You can't treat an illness you refuse to name. So let's name it clearly. This is a trust recession. Prices falling are just the symptoms. The disease is disbelief in the system's ability to self-correct. And that disbelief, once it takes hold, you see, can cause even solid institutions to stumble, because when people lose faith, they pull back from everything: spending, investing, risk-taking, and that withdrawal is what freezes economies. So here's where we are. We're standing at the edge of a cycle where trust is eroded faster than policy can rebuild it. The crash isn't a single event, it's a sequence that unfolds as confidence drains away. And in my experience, when that happens, you don't fight the tide, you prepare for it. Now that you understand the diagnosis, that this is not just about markets, but about confidence, not just about money, but about behavior, the next thing we'll talk about is how institutional failure spreads and why it affects you even if you never bought a single share of stock. You see, what begins in boardrooms always ends at kitchen tables. So stay with me, because in the next part, we'll walk through exactly how that contagion works and why recognizing it early can mean the difference between surviving a downturn or being swallowed by it. You know, when I talk about institutions failing, most folks picture a big bank going under or a government shutdown splashed across the evening news. But let me tell you something, that's not where the failure starts. It begins quietly, behind closed doors, in board meetings and policy briefings where people stop telling the truth to one another. You see, institutional failure always starts with silence, with people choosing comfort over candor. Now, once that silence sets in, it spreads like a leak in a dam. At first, it's just a trickle, a little miscommunication here, a little accounting trick there. But before long, that trickle becomes a flood. And when it bursts, everyone downstream gets soaked. That's what I mean by contagion. You see, it's not just financial, it's behavioral. You understand, in markets, trust is the currency that never appears on a balance sheet. The minute that currency devalues, everything else, stocks, bonds, real estate, follows it down. When an institution's word is no longer believed, every contract that is written suddenly carries risk. That's why contagion spreads faster than logic. Logic says they'll manage it, but emotion says get out before it's too late. Let me walk you through how that contagion moves through the system, step by step. It starts inside the institution, maybe a bank, maybe a government agency, maybe a corporate board. Someone fudges numbers, hides a loss, delays bad news. For a while, it works. Then rumors leak. Confidence wobbles. Suddenly, investors, employees, and counterparties start asking the same question: can I still trust them? You see, once that question appears, the answer doesn't even matter anymore. The damage is done because uncertainty itself is toxic. From there, it moves to the financial system. Lenders tighten credit, counterparties pull collateral, interest rates on short-term loans spike as everyone starts hoarding liquidity. You see, it's the financial version of people buying bottled water before a hurricane. Nobody knows how bad it'll be, but everyone wants to be safe. Then it spills over into the real economy. Businesses delay expansion, households postpone spending, governments face revenue shortfalls, and what began as one institution's credibility problem turns into everyone's slowdown. You know, I've often said that markets are like ecosystems. When one part rots, the decay doesn't stay in one corner. The system's connected by confidence, and when that connection breaks, the infection travels faster than you can model on a spreadsheet. You see, that's the part too many analysts miss. They measure exposure in dollars, but they forget to measure exposure in trust. Now, let's take a step back and look at history. In the Great Depression, it wasn't just bad loans that wrecked the system. It was the loss of faith in banks themselves. In 2008, it wasn't only mortgage-backed securities. It was the realization that the people who built those securities didn't even understand their own risk. And right now, what we're seeing is another version of that same story. It's not just bad numbers. It's bad credibility. You see, the bigger the institution, the more dangerous its silence. When a small company hides a problem, it hurts shareholders. When a major institution hides one, it endangers the system. And that's where we are in a phase where big players are pretending small problems will stay small. They won't. They never do. Well, let me tell you how it feels when that illusion breaks. It's not a sudden explosion. It's a slow bleed of confidence that accelerates until one headline finally tips the scale. One earnings miss, one downgrade, one scandal, and the whole structure shakes. Traders call it a cascade, but you know what it really is? It's trust leaving the room. Now, some of you might say, Warren, isn't this all too gloomy? No, you see, it's not gloom. It's realism. Institutions, like people, are mortal. They live on credibility, discipline, and accountability. When those fade, they don't collapse instantly. They decay. And the smart investor doesn't panic. He observes that decay and prepares for what follows. Here's how contagion translates to your world. When banks tighten credit, your loan applications take longer, your interest rates rise, and your small business line of credit shrinks. When corporations hoard cash, they freeze hiring, cut benefits, and delay raises. When governments lose credibility, their bonds lose buyers, and that drives up borrowing costs for everyone. So you see, even if you've never owned a stock in your life, you're still inside this ecosystem. The hardest part for most people is recognizing when that quiet erosion of trust becomes irreversible. By the time the newspapers say crisis, the real damage is already done. So what you have to do, you see, is train yourself to spot the behavioral cues, not just the market data. When CEOs start using vague language in earnings calls, when regulators delay reports, when politicians start blaming market forces instead of policy, those are your early warnings. You know, in corporate boardrooms, I've seen it up close, when a company starts holding more meetings about communication than about performance, that's when you know the inside confidence is gone. It's like watching a captain rearrange deck chairs while the ship lifts to one side. That's institutional failure, not a bang, but a slow drift toward self-deception. Now, the contagion doesn't just hurt balance sheets, it changes behavior. Investors become short-term thinkers. Managers become risk-averse. Politicians become populist. You see, the infection moves from finance to culture. That's why a financial crisis always leaves behind more than empty accounts. It leaves behind cynicism. And cynicism, once it spreads, can paralyze progress for years. Let me be clear here. We can't stop contagion by pretending confidence will return on command. We stop contagion by rebuilding credibility inch by inch. That means transparency, accountability, and patience. Three things modern markets are not very good at. But if we fail to restore those, no bailout or stimulus will last. Now, I want you to understand the full picture. Institutional failure is not the end of the story. It's the middle of a cycle. Systems break so they can reset. But the reset only benefits those who kept their powder dry, those who didn't chase the last wave of euphoria, and who have the patience to act when fear peaks. You see, in a contagion, panic makes people sell what they should hold and hold what they should sell. The winners are the ones who remember that every collapse plants the seeds of the next recovery. That's the paradox of capitalism. It purges excess, punishes arrogance, and rewards discipline. So, when you watch the next wave of headlines, don't just ask, what's the price today? Ask, who's losing credibility and why? Because that's how contagion really works. It's not about numbers falling, it's about belief unraveling. And the next section, I'll show you what that unraveling looks like in practical market terms, what a crash actually feels like from the inside out, and how ordinary investors can navigate it without losing their heads or their savings. You see, preparation isn't about prediction. It's about survival, calm, informed, deliberate survival. You know, people like to say this time is different, but let me tell you something, it almost never is. The faces change, the headlines change, the technology changes, but human behavior, well, that stays the same. You see, history doesn't repeat word for word, but it sure rhymes loud enough for anyone paying attention. Now, if you look back across a lifetime of markets, and I've lived through quite a few, you'll notice every major crash followed the same emotional curve. Confidence, overconfidence, denial, panic, and finally, clarity. That pattern is older than Wall Street itself. You understand the seeds of every crash are planted in the soil of the last recovery. Let me walk you through a few moments that taught me that truth, one lesson at a time. Back in the late 1920s, America was convinced that prosperity had no ceiling. The stock market had become a national pastime. Taxi drivers, barbers, teachers, everyone was trading. The economy was roaring, credit was easy, and people thought they had found a new formula for wealth without risk. But underneath all that excitement, leverage was building quietly. You see, investors were buying stocks with borrowed money, convinced the music would never stop. Well, when it did, the fall was swift and brutal. And the lesson? You never borrow confidence from the future, because the bill always comes due. Fast forward to the 1970s, inflation was eating away at savings, energy prices were soaring, and trust in government had collapsed after Watergate and Vietnam. You see, people forget that the loss of faith in institutions, not just economics, deepened that recession. Investors didn't just lose money, they lost belief. The stock market went nowhere for almost a decade. The lesson there was clear as daylight. When leadership credibility collapses, markets follow, no matter what the charts say. Then came the late 1990s, the dot-com boom. I remember sitting in meetings where young analysts would tell me, "Warren, you just don't get it. This time it's different." They said profits didn't matter anymore. It was all about clicks, eyeballs, and potential. I smiled politely and said, "Well, you might be right, but I'd still like a business that earns money." You see, when people start redefining the laws of value, it's a sign they've lost touch with gravity. And gravity, my friend, always wins in the end. After that came the 2008 crisis, a crash that was dressed in sophistication, complex models, exotic derivatives, AAA ratings on junk. You see, the problem wasn't ignorance. It was arrogance disguised as intelligence. Everyone thought the system was too advanced to fail. But as it turned out, the smartest guys in the room were often the ones taking the dumbest risks. That was the most expensive education Wall Street ever paid for. The lesson? Complexity doesn't make risk disappear. It just hides it until it's too big to manage. And here we are again. You see, this cycle isn't about dot-coms or subprime loans. It's about something deeper, overconfidence in the ability of institutions to control outcomes. People have come to believe that central banks can always bail out markets, that governments can always borrow more, that technology can always outgrow cost. Well, I'll tell you this, belief itself can become a bubble. And when that bubble bursts, the crash doesn't just hit your portfolio, it hits your assumptions about how the world works. Now, let's talk about the emotional rhythm that runs through every crash. First, euphoria. That's when everyone's making money and caution sounds boring. Then comes denial, a few voices start warning, but they get laughed off as pessimists. After that, panic sets in when people realize prices don't just go up. Then comes capitulation, when everyone sells not because they want to, but because they have to. Finally, recovery not of prices first, but of discipline. You see, I've always said markets are like a mirror reflecting human nature, fear, greed, hope, and pride. And the reason most people lose money is because they stare into that mirror and mistake emotion for opportunity. They buy when it feels good and sell when it feels bad. But you understand, wealth is built by doing the opposite, buying when it feels unbearable and selling when it feels euphoric. In the Great Depression, the investors who survived were the ones with patience and liquidity. In the 70s, it was those who focused on real assets and productivity. In 2008, it was those who stayed away from what they didn't understand. You see, history rewards humility. It punishes overconfidence every single time. Now, let me tell you something about timing, not market timing, but emotional timing. You can't predict when the market will hit bottom. Nobody can. What you can predict is when people will start losing their nerve. That's usually the real signal of opportunity. When fear becomes louder than reason, that's when the value hunter should sharpen his pencil. But the trick is, you have to prepare before that moment arrives. Because when fear floods the room, you won't have time to think clearly. The crowd's panic will infect your mind faster than any virus. That's why you build your plan in calm time, so when chaos hits, you just follow the plan. You see, Planning is a form of discipline, and discipline is the bridge between knowledge and survival. Now, if you compare this moment to the past, there's one crucial difference. Back then, the crises were mostly financial. Today, they're systemic, political, social, technological, and environmental all at once. That makes this crash more complex, but the human element remains the same. People overestimate what they control and underestimate what they depend on. The lesson through all this, you understand, is not despair, it's perspective. Every crash clears the field. It forces excess out of the system and gives disciplined investors a clean slate to build on. The problem is, most people give up just when the soil becomes fertile again. I'll tell you, this opportunity doesn't announce itself with a trumpet. It shows up quietly, disguised as pain. The best investments I ever made were in times when everyone else was running away. You see, courage isn't acting without fear. It's acting with fear, guided by reason. So when you hear that the market is crashing, don't see it as an ending. See it as a test of patience, temperament, and preparation. Because that's all investing really is, a long exam on emotional stability, graded by time. Now that you understand the rhythm of history, how greed turns to fear and back again, we're going to move next into the practical side of this. You see, talk is cheap unless it leads to action. So, in the next section, I'll walk you through what a market crash actually looks like in motion, what it does to prices, liquidity, and behavior, and how to survive it step by step without losing your shirt or your sanity. Stay with me, because understanding the mechanics is how you turn fear into strategy. You know, when people imagine a market crash, they picture one big day, prices plunging, anchors on television gasping, and investors running for the exits. But let me tell you something, a crash isn't a single day. It's a process, a slow motion chain reaction that starts quietly, then accelerates until everything that seems solid begins to shake. You see, by the time it feels like a crash, the damage has already been unfolding for weeks, sometimes months. Let me paint the picture for you the way it really happens. It usually begins with complacency. Prices rise for months or even years, volatility drops, and people convince themselves that the system has changed. This time it's different, they say. You know, I've heard that line more times than I can count, and it's never true. In that phase, investors stop worrying about risk. They chase yield. They buy on margin. They forget that what goes up can, and eventually will, come down. Then comes the first tremor. It's not loud. Maybe a surprising earnings report. Maybe a missed target. Maybe a policy decision that shakes confidence. You see, it's never the big blow that scares professionals. It's the small one that they didn't expect. That first tremor wakes up the cautious players. They trim exposure. They reduce leverage. But the crowd doesn't notice yet. Everyone says it's just a healthy pullback. A few days later, liquidity starts to dry up. Market makers widen spreads. Lenders begin asking for extra collateral. Hedge funds start selling to meet redemptions. The volume builds quietly. That's the sound of the plumbing in the financial system beginning to clog. You understand? Liquidity is like blood in the body when it stops flowing. Even healthy organs start failing. Now the second phase begins what I call forced selling. This is when prices fall, not because people want to sell, but because they have to. You see, margin calls don't wait for logic. They come automatically. And when institutions need to raise cash, they don't sell the bad stuff first. They sell what still has a bid. That's why in every crash, the good assets fall along with the bad. It's not about quality at that point. It's about survival. Let me tell you something. When fear takes over, rationality doesn't just fade. It flees. Traders dump positions they spent months building. Algorithms start selling mechanically. The faster prices fall, the faster fear spreads. And once that happens, fundamentals stop mattering. Nobody cares about price to earnings ratios or long-term potential. The only question becomes, how do I get out before it's worse? That's when you know the panic phase has arrived. You see it in the headlines first. Phrases like historic decline, market meltdown, worst day since fill every screen. On television, experts who were confident a week ago now sound like historians, explaining what went wrong instead of what to do next. That's the moment when the crowd finally realizes the party's over. Prices don't move down in a straight line. They cascade, one stop loss after another, feeding on momentum and fear. Then something peculiar happens. As the sell-off intensifies, even safe assets get hit. Gold, bonds, blue chip stocks, they all drop, not because they're weak, but because investors are desperate for liquidity. It's a cleansing fire that burns indiscriminately. And when that fire rages, even strong hands start shaking. Now, at this stage, emotional contagion becomes more powerful than data. You see, the same human instincts that helped our ancestors run from predators make modern investors run from red screens. Panic is primal, and that's what you must guard against more than anything else, your own instincts. Because in a crash, the enemy isn't just the market, it's your reaction to it. Well, let me tell you what happens next, the paralysis stage. After weeks of chaos, people become numb. They stop checking accounts. They avoid financial news. They convince themselves it's hopeless. That's the emotional bottom, not necessarily the market bottom. You see, markets recover long before people do. By the time the average investor decides it's safe again, the smart money has already started buying. Here's the part most folks miss: crashes are not purely negative events. They are moments of price discovery. They reveal what assets are real and which ones were fantasy. A crash is the market's way of resetting valuations back to sanity. You see, value doesn't disappear in a crash. It transfers from the impatient to the patient. Let me give you an image. Imagine a forest fire. It looks devastating, doesn't it? Trees burn, smoke fills the air, and everything seems lost. But what happens a few months later? The soil becomes richer. New growth begins. Nature clears out the weak to make room for the strong. Well, the market works the same way. It punishes excess and rewards discipline, always has, always will. Now, here's something most people don't understand about the recovery phase. It doesn't start with good news. It starts with the absence of bad news. You see, prices stop falling not because everyone's suddenly optimistic, but because sellers have run out of things to sell. Slowly, the panic selling dries up, liquidity returns. A few brave investors start buying, quietly at first. Then confidence trickles back and the market stabilizes. But here's the trap. After every crash, there's a dead cat bounce. A sharp rally that convinces everyone the worst is over, only to roll over again. You understand, recovery isn't smooth, it's jagged. Real recovery takes patience, months or even years of rebuilding trust. And that's why those who buy too early or too late often end up with the same result, regret. So what should you do when a crash is happening? I'll tell you this: don't run with the herd and don't fight the storm head on. You can't stop the tide with a bucket. But you can build higher ground. That means holding quality, keeping liquidity, and knowing exactly what you own and why you own it. If you can't explain your investment in one sentence, you probably shouldn't own it during a crash. During a crash, cash is courage. It's optionality. It lets you act when others can't. And more importantly, it buys you time, and time is the one asset that appreciates during chaos. Now, one final thing before we move on. Every crash I've witnessed has had two parallel battles, one in the market and one in the mind. The market crash lasts months. The mental one can last years. People lose faith, not just in the system, but in their own judgment. That's why discipline, patience, and humility matter more than any strategy. You see, a crash is less about losing money. It's about not losing yourself. So now that you understand what a crash feels like in motion, from complacency to capitulation, the next thing we'll talk about is how to prepare while you still can. Because knowing what's coming is only half the fight. The other half is positioning yourself so that when everyone else is drowning in noise, you're calm enough to see the opportunity floating to the surface. Stay with me, because the next section is where we get practical, clear rules, plain steps, and the habits that separate survivors from victims in a downturn. You know, when people hear the words market crash, their instinct is to ask, what should I buy? But let me tell you something, that's the wrong first question. The right first question is, how do I protect what I already have? You see, investing in a storm isn't about chasing opportunity first. It's about building shelter first. You can't plant seeds in a hurricane. Now listen carefully, because this next part is where most investors separate themselves from the crowd. What I'm going to walk you through are practical, time-tested rules that I've seen work across every kind of market. Not fancy formulas, not trading tricks, just plain discipline backed by experience. You see, these are the same principles I've lived by when the lights were flickering on Wall Street and everyone was losing their nerve. So let's start with rule 1. Keep cash handy, but don't worship it. You see, cash is not for earning, it's for breathing. When markets crash, the investor who has liquidity has options. Everyone else has anxiety. You understand, in calm times, people hate holding cash because it feels lazy. But in rough times, that same cash becomes priceless. It lets you buy good assets at half the price, and it lets you sleep at night. But here's the balance. Don't sit entirely in cash out of fear. Inflation eats idle money like termites in a wooden house. You need cash as a tool, not a hiding place. I like to think of it as sleep well money, enough to make you calm, but not so much that you miss opportunity when the dust settles. Now, rule 2, own quality businesses, not tickers. You see, in a crash, the market punishes everything. The difference is quality recovers. Junk doesn't. If you own a business that sells something people will still need in 5 or 10 years, that's value. I'm talking about companies with moats, pricing power, strong management, and cash flow, even in bad weather. You understand, it's not about how exciting the stock looks on television. It's about whether the business can survive a dry season without begging for capital. Let me tell you this, in a panic, good companies get thrown out with the bad ones. That's not a reason to despair. That's your chance, because after a crash, capital flows back to quality first. The investors who recognized that, who kept faith in businesses that still made sense, were the ones who doubled their wealth while others were still licking their wounds. Now, rule 3, never, ever play with leverage. You see, debt is like oxygen. You don't notice it until it's gone. Leverage amplifies both greed and fear. When times are good, it makes you look smarter than you are. When times are bad, it makes you go broke faster than you thought possible. I've seen smart people lose decades of work in a single bad week because they borrowed to buy what they couldn't afford to lose. In a crash, cash is king, but debt is the executioner. The moment your investments depend on borrowed money, you've given up control. You understand, the goal of investing isn't to look brilliant in a bull market, it's to stay solvent in a bear market. Now let's move to rule 4. Know your time horizon and stick to it. Markets move in cycles, but your goals shouldn't. You see, the reason most people fail during crashes isn't lack of intelligence, it's lack of patience. They react to every headline as if the world ends tomorrow. But investing at its core is about owning productive assets for the long haul. If you need money next year, it shouldn't be in the market today. If you're investing for 20 years, a crash is not a tragedy. It's a sale. Let me tell you something from personal experience. I've never met anyone who consistently made money predicting market bottoms, but I've met plenty who made fortunes by simply refusing to panic. The price of admission to long-term wealth is short-term discomfort. You see, volatility is not risk. Permanent loss is risk. Now, rule 5, diversify intelligently. You see, diversification is not owning 50 stocks. It's owning different types of assets that don't all panic together. Own productive businesses, little cash, maybe some bonds, maybe some real assets, but make sure every dollar you invest has a clear purpose. Don't diversify just to feel busy. Diversify so that no single mistake can ruin you. And here's a simple test. If you can't explain why each investment belongs in your portfolio in one plain sentence, you're probably over-diversified. You understand, too much diversification isn't safety, it's confusion. And confusion costs money. Now, rule 6, protect your temperament like your capital. You see, markets crash often, but investors panic more often. Your emotions will betray you faster than any market correction. That's why the most important investment you'll ever make is in self-control. The market tests your character before it rewards your wallet. When fear hits, you'll be tempted to sell good assets just for relief. Don't. Relief is temporary. Regret is expensive. Create a written plan before the crash, what you'll buy, what you'll sell, and when you'll act. Then, when panic hits, read your own plan instead of the headlines. Now, rule 7, reinvest with discipline. You see, When the crash subsides and prices look cheap, that's when hesitation creeps in. Everyone says, what if it falls further? Well, it might. But if you wait for the perfect bottom, you'll miss the real opportunity. Start small, add gradually, build confidence with data, not emotion. And here's something I've learned. The first buys after a crash don't feel good. They never do. They feel lonely, even foolish. But 6 months later, they usually look wise. You understand, courage in investing isn't the absence of fear. It's the ability to act through fear, guided by preparation. Now, Rule 8 review, your circle of competence. In times like these, simplicity beats sophistication. Stick to what you understand. You see, complexity is seductive. It makes you feel smarter than you are. But the truth is, when the system shakes, only the simple things hold. If you can't explain how an investment makes money in one breath, don't touch it. Finally, Rule 9, remember that your biggest asset is yourself. In a crash, skills, adaptability, and judgment matter more than portfolio charts. You can lose half your wealth and still recover if you maintain your mindset and discipline. But if you lose your confidence and clarity, no portfolio can save you. Let me tell you this, the greatest hedge against uncertainty is competence. Learn, read, think. Understand the businesses you own, the principles you invest by, and the values you refuse to compromise. That's what gets you through a storm. You see, the market doesn't reward panic or perfection. It rewards preparation. Now that you have these rules, we'll move next into how to apply them, what steps different types of investors can take right now to protect themselves and position for the rebound. Because the principles are universal, but the actions differ depending on who you are and where you stand. So stay with me, because the next section will make these ideas personal for retirees, working investors, traders, and business owners alike. We'll turn theory into practice. When people ask me for investment advice during a crash, they often expect one-size-fits-all wisdom. But let me tell you something, there's no single roadmap that fits everyone. You see, every investor lives in a different season of life. A retiree doesn't need the same strategy as a 30-year-old worker, and a small business owner can't play by the same rules as a professional trader. You understand, your plan must match your purpose. So what I want to do here is walk you through clear, practical moves for different types of investors. Not theory, not hype, just calm, experience-based direction for real people living through real market pain. The biggest risk for retirees isn't missing out on gains. It's running out of money when you can't afford to start over. That's why your number one job in a crash is capital preservation. Keep at least 2 to 3 years of living expenses in cash or near cash instruments, things like treasury bills, high-quality savings accounts, or short-term bonds. You see, that buffer keeps you from selling your investments at bad prices just to cover bills. It gives you emotional and financial breathing room. Next, focus on income reliability. If you depend on dividends, be sure those companies can actually sustain them. A healthy dividend yield means nothing if it's paid by a weak balance sheet. Check the payout ratios and debt levels. If they're stretching to pay, trim those positions before the cut comes. Now, when markets are falling, it's tempting to move everything to cash. Don't do that completely. You see, longevity risk, the danger of outliving your money, is as real as market risk. Keep a modest portion in strong, dividend-paying equities or conservative funds that can grow over time. Your goal isn't to win, it's to endure. And let me tell you this, avoid panic moves triggered by television or friends. Retirement investing is like steering a big ship. It doesn't turn fast, and it shouldn't. Stay steady, rebalance slowly, and remember, predictability is your ally. For those still earning, a crash is not a tragedy. It's an invitation. You see, you have the most powerful advantage in investing time. When markets drop, the value of your future contributions rises automatically. Every paycheck buys more ownership at cheaper prices. That's why consistent investing during a crash through dollar cost averaging is your best friend. Keep contributing to your retirement plans and investment accounts even when it feels awful, especially when it feels awful. I'll tell you something from experience. In the long run, wealth doesn't come from buying at the bottom. It comes from continuing to buy through the bottom. You see, most people quit too soon, right before the rebound. Discipline is what separates the frustrated from the free. Now, this is also the time to clean up your financial foundation, pay down high-interest debt, increase your emergency savings, and learn a new skill or side income stream. The best way to protect yourself from market chaos is to strengthen your personal balance sheet. You understand, the more stable your income and expenses, the bolder you can be with your investments. If you're in your 30s, 40s, or early 50s, remember this: every crash you live through becomes a teacher, not a punishment. The money you invest during fear will likely outperform the money you invest during euphoria. I don't often speak to traders because our philosophies are worlds apart. But if you trade actively, let me give you this warning: crashes can humble even the smartest professionals. The goal during high volatility isn't to prove how brave you are. It's to stay in the game. Cut your position sizes, tighten your stop losses, trade smaller, think slower. When volatility spikes, your risk of ruin rises exponentially. You see, the market can stay irrational longer than you can stay funded. In a crash, information moves faster than your emotions can process it. That's when traders overreact, revenge trade, and destroy months of progress in a day. Don't fall into that trap. Survive first, profit later. And let me tell you something that will save your sanity. It's okay to do nothing. Sitting on your hands can be the smartest trade you'll ever make. If the setup isn't clear, walk away. There will always be another opportunity when the dust settles. You see, a market crash doesn't just hit stock portfolios. It hits customers, suppliers, credit lines, and payrolls. As a business owner, your job is to protect the engine that generates your wealth, your business itself. The first thing you need to do is preserve liquidity. Build a cash reserve that can cover at least 6 months of expenses. That's not pessimism, that's prudence. Liquidity is survival fuel for businesses during downturns. Next, prioritize your core customers. Crises have a way of revealing who your real market is. Focus on your strongest relationships and most profitable products. Trim the distractions. Simplify operations. You see, efficiency becomes your best defense when demand slows. Third, negotiate early and often. Don't wait for suppliers or lenders to tighten terms. Call them first. Show transparency. In tough times, honesty is a bargaining chip. Most institutions prefer a prepared partner to a silent one. And here's something many forget: a crash creates once-in-a-decade opportunities for expansion. Strong businesses can acquire weaker competitors at a fraction of their worth. But that only works if you manage your debt and kept reserves. You understand, fortune favors the disciplined, not the desperate. Finally, communicate with your team. You see, uncertainty spreads faster than any rumor. Tell your people the truth. Panic grows in silence. Leadership in a downturn isn't about speeches, it's about steadiness. No matter who you are, a retiree, a worker, a trader, or a business owner, the golden rule is the same. Control what you can, prepare for what you can't. You can't control the Federal Reserve. You can't control political drama or global markets. But you can control your expenses, your cash flow, your debt, and your reactions. Let me tell you something I've learned after decades. The people who survive crashes best aren't the ones who predict them. They're the ones who respond to them rationally. They breathe, they wait, and they act with clarity while everyone else is shouting. Because, you see, wealth isn't built in good times, it's revealed in bad times. When markets shake, everyone looks to governments and central banks for rescue. But let me tell you something, they can calm nerves, not fix cycles. Policy doesn't stop storms, it just slows the wind. When fear spreads, central banks cut rates and flood the system with money. You see, it works for a while, but each rescue buys less time than the last. Liquidity can't replace confidence. And confidence, once lost, isn't printed back. Then governments step in with spending plans and relief packages. Some of it helps, but much of it just shifts pain into the future. Every borrowed dollar is a claim on tomorrow, and tomorrow always comes due. The smart investor doesn't cheer every stimulus headline. He watches where the money goes. If it builds productivity, infrastructure, energy, innovation, that's a foundation. If it just patches holes, that's temporary comfort. Now, there are only 3 broad outcomes from here. First, policy works and the system stabilizes a slow, uneven recovery. Second, policy overreaches, inflation bites, and hard assets do better than paper. Third, policy stalls, politics blocks action, and uncertainty lingers. You see, you don't need to predict which one happens. You prepare for all three, hold quality if recovery comes, real assets if inflation rises, and cash if paralysis drags on. That's not brilliance. That's balance. The crowd reacts. The disciplined prepare. Because in the end, policymakers will do what they always do, try to restore confidence with liquidity. But you and I must restore discipline with patience. After all the talk about markets, cash, and policy, it really comes down to one thing: how you behave when everyone else is losing their head. Because let me tell you something, temperament beats talent every time. In a crash, don't confuse motion with progress. Doing something isn't the same as doing the right thing. Sometimes the smartest move is to stay still, breathe, and think. Anchor yourself to principles, not predictions. You see, predictions change by the hour, but discipline lasts. Buy value, avoid debt, hold quality, and stay patient. That's how you survive every storm I've ever seen. Filter the noise. The louder the panic gets, the less it usually matters. Don't live on headlines. Keep your circle small and your focus long. And remember, this fear is information, not instruction. Use it to think clearly, not react blindly. Every generation believes its crisis is the worst. It never is. The world bends, but it doesn't break. You see, we rebuild, we learn, and we move forward. So stay steady. Keep cash for courage, keep faith for perspective, and keep your head when others lose theirs. The market doesn't reward panic, it rewards patience. And when the dust settles, you'll find that survival itself was the best investment you ever made. Thank you for your time.